All right. Well, let's go ahead and get started. Today, we're going to be talking about alternative investments, which includes Bitcoin, which includes gold, private markets, and a whole host of other investments that are outside of your traditional public markets like stocks and bonds. I'm Tanner Wrisley. I'm the Chief Investment Officer here at Anchor Bay. I graduated from Harvard with an economics degree and found my way back to Carlsbad, where I grew up, and now helming the investment arm of Anchor Bay. And also with us is Corey Large.
Yeah, hey everybody, I'm Corey. I am a portfolio analyst here, working alongside Tanner on the portfolio team, constantly monitoring investments, seeing what fits well for portfolios. And then I also am a tax member for a few months out of the year as well. I do some tax preparation and consulting as well. And a little background about me, if you didn't know, I went to school at Cal State San Marcos and got my degree in finance. And I helped lead the student run investment fund there for a few years and found my way back to Anchor Bay, where I'm very happy to be. And it's a great team. So, yeah, I'm very, very stoked to be here and to be presenting to you guys today. And I think we have a really good presentation here. So, very excited.
Yeah, awesome. So, as I mentioned, we're going to be talking about alternative investments today. Um, it's sort of as the previous slide showed, it's sort of a new era and a new these asset classes are becoming more and more accessible, and slowly becoming a part of what we feel like should be a regular part of people's portfolios. And that's why we're sort of doing this webinar to hopefully educate, as well as maybe spark some initial conversations to see if these types of investments are right for you. We're going to break it down into three sort of categories: private markets, cryptocurrencies, and commodities. Alternatives is sort of a broad definition for a lot of different things, a lot of different asset class types. For the purpose of this webinar, we're going to be focusing on these areas because we feel like they're most pertinent to our clients and to really most investors. Um, I'm going to start off by talking about private markets, and the private markets can be broken down into different categories as well. And so on this slide, I've kind of broken it down next to its public market counterpart. So, for example, the first one, private equity, is akin to the stock market, right? It's corporations, it's companies, just like you have in the public market when you own a stock, it's ownership in a company. It's just a publicly traded company. Their shares are trading on the New York Stock Exchange, which makes it very easy to buy and sell. And in fact, ownership in stocks is bought and sold billions and trillions of times a day, a week, through trading on the open market. Whereas private equity is a lot. There's a lot less trading and changing hands, but it's the same type of ownership in a corporation or a company. So private equity, that's one. We also have private credit, and this is sort of the private market equivalent of fixed income or bonds, essentially corporate bonds. Again, it's fixed income, it's bonds, it's debt or credit in a company. It's just, instead of it being a publicly traded company where their debt is traded on a exchange, these are private companies, and their debt is um, accumulated and kept private. Um, REITs, are akin to private real estate. There's private real estate, and then REITs are the publicly traded version of real estate. And then the last one is public infrastructure and private infrastructure. This is sort of a newer asset class, and it actually kind of commingles with private equity and private real estate. In private infrastructure, you might have some ownership in corporations. You might have some ownership in actual assets, like a cell tower or something along those lines. Or you might have ownership in real estate, like a data center where you're part of a group that owns the actual building and then leases out their data center to like a Meta or um, a tech company that's going to power their AI through it. So that's private infrastructure. I do want to make a quick note on private infrastructure because the other ones I'll be going into more detail. But again, this private infrastructure is sort of a newer asset class, and it's just a mixture of equity and real estate that's focused on things that are the build out of our economy and our power grids and things of that nature. So participating in that kind of growth. Okay, so why invest in private markets? Well, one of the main arguments is diversification. And so this is what we call a correlation matrix. And I'm going to pull out the laser pointer real quick so you guys can follow along. So one is essentially a one-for-one match. For example, if you look in this column, S&P 500 is 1-to-1 with the S&P 500. So it means the return is identical. Another example, let's say if we looked at the S&P 500 and the NASDAQ, so 0.92, meaning they're very similar. You're almost getting the same return in either of these indexes. So if you think you're being diversified by having an S&P 500 index and and a Nasdaq 100 index investments, you're really not. It's very similar in terms of their return profile. Um, some of these other stock indexes, like the Russell 2000 and the S&P 0.86, or how about even the Dow Jones Industrial Average and the S&P 0.89. So all very similar, highly correlated. You're not getting a ton of diversification by having both types of investments there. Well, let's look at bonds. And I'll use the S&P 500 versus the aggregate bond index. And again, these are all publicly traded so far. 0.36. So that's quite a bit less correlation, which is good. And that's why we use in the public markets, we use fixed income a lot because they're not very highly correlated with stocks. They can be sometimes, but you can see it's a lot better than trying to diversify by buying the Dow Jones and the S&P 500. Where it gets really interesting is in this column here. So this PRIVX is an example of a private equity fund. Specifically, this is a late stage venture capital fund. So these are companies that they anticipate to IPO or go public in the near future. So they're sort of like the closest step to being public without being actually public. And you can see they're even less correlated than the bond market was 0.23. So you do get massive diversification benefits while still being in the equity business, if that makes sense. So it's a huge benefit as far as when the stock market is tanking, it doesn't necessarily mean that your private equity fund is also going to be tanking. And we have some pretty good examples of that coming up as well. Um, So same looking at the same fund. Again, this is the closest thing to public stocks without being public stocks. They're on the precipice of becoming public. And this chart looks at the um, 10 worst performing months of the S&P 500 over the last 11 years. The dark gray bar is the Russell 2000. That's sort of a small cap index, so smaller companies. And we all know that S&P 500 is large U.S. companies. And then this is the private equity fund that was on the last slide as well. And you can see in these times of massive drops, here's like the COVID drop. It actually performed a slight positive, if not flat. Um, some of these other drops, again, nothing anywhere close to what the public markets were doing. So it's another example of how they're not correlated, but it also shows that they can be quite defensive. These private equity funds, as well as other private market funds. Um, so why is that? Well, part of it is because of the illiquidity element that comes with these private markets, these private market funds. Publicly traded stocks are being traded and changed hands, as I mentioned, millions of times a day. So they're able to react and overreact on every single bit of news and everything that goes on in the market. Well, these private investments are a little harder to get out of, which can be a negative, but it can also sort of help protect against panic selling and allowing people to kind of ride out maybe a short term blip. Earlier this year during Liberation Day, if you joined us for our mid year recap on the markets, we talked about how during Liberation Day the stock market dropped massively, and then it came back right away and almost made up everything within a few days. Well, we didn't even see that drop on private equity funds because there was no time. You have to submit your sales way ahead of time, and it takes a quarter usually to get out of them. And so they're really if you were in a private equity fund, you were really protected from that short-term blip. So just an example of how the downside protection can be pretty nice on some of these private equity funds. Um, Here's a nice graph that looks at the global financial crisis, um, and it shows again the three types: REITs, stocks, and bonds. The public side and the private side. So if you look at stocks, for example, this light blue line, um, publicly traded stocks, S&P 500 was down 46% at its worst, whereas the its private equity counterpart, down 27. So quite a bit less. How about real estate? So publicly traded REITs, obviously during the the global financial crisis, was kind of brought on by real estate. So you can see 65% downside, whereas the private real estate only was only down 38. And then lastly, fixed income, publicly traded fixed income down 30% at its worst, and private credit only down 8%. So massive downside protection for these funds. So then everything in our industry and everything we sort of preach to our clients is okay, there's a risk reward trade-off. So if these private market funds are um, doing a good job protecting on the downside, they must be giving up some upside, right? They must be not returning as well when the market does, when all things are firing. Well, private markets may be the sort of cheat code for beating that risk reward profile. I'll get to what you have to give up because there are certain limitations. But as long as you are okay with those limitations, the risk reward trade off is a lot of times in favor of these types of assets. This chart breaks down volatility, which measures, how rapid the ups and downs of the investment class is, and the return. So where you want to be, ideally, we love to have something with a lot of return and no volatility. So that would be up and to the left. And what you can kind of see here is these private investments are sort of all up and to the left. Here's the private equity with a similar return profile to U.S. large cap stocks, except with about half the volatility. Um, we'll look at real estate here. Here's private real estate, and here's publicly traded real estate. So publicly traded real estate looks like it's got a slight edge on performance, but private has so much less volatility. And then private credit is here, very little volatility with a pretty good return profile. And here's the U.S. corporate bond index with, again, not very much volatility, still more than private credit, but nowhere near the return profile. I also do want to mention, even within sort of publicly traded investments, there are some discrepancies. Like this is a shorter term. We're looking back kind of more recently with this graph. So U.S. large cap has actually outperformed small cap recently and REITs. And one thing I think that kind of stands out here is the return profile of commodities versus U.S. stocks. They're about the same volatility, and yet the return profile is much higher. Um, so, okay, if private markets are so good,
Why
they
not
give
go
us more
100%?
return with less volatility. Why aren't we doing that? Why aren't we just putting 100% of our portfolio into private markets and getting higher return for less risk? Well, there's all these different limitations. So one of the big ones, and the biggest reason why you get that risk reward trade off in favor of private markets is because you're giving up liquidity. These funds all have lockup periods, usually of at least a year, sometimes even longer, where you're not allowed to sell, or maybe you can sell, but you'll have to pay a massive fee that makes it not a good idea to sell before the lockup period is over. The other thing is you're not going to get pricing like you would a stock where it's constantly changing. You know exactly what the value of your investment is. Some of these funds price once a quarter, and the pricing is not it's not based on publicly traded data. It's whenever they can get a price. So if you have a private company that has done, let's say they've done a round of funding, and they go sell some of their shares privately, we know what that person or that fund or whoever bought it, we know what they paid, but they might not go out for another round of financing for like 5 years or something. And so the price just kind of sits stagnant in there for a long time. And in reality, the real price might be much different than what you see when you go to look at your account and go to look at what the fund is. So you have to be comfortable with knowing those weird kind of quirks of working in the private markets. And the other thing with this illiquidity is the redemptions and the gates. So most of these funds have parameters that say, okay, you're only allowed to sell on this day in the quarter. So you can only sell at 4 days in the year. And you have to submit all this documentation at least a month before. And we also reserve the right to deny your redemption request. Some funds, and it varies from fund to fund, but some funds will say your redemptions, or in other words, like selling the fund, is subject to a board approval. Or sometimes they'll say, we will accept your redemptions as long as it's not more than 5% of the fund's NAV, which essentially means whatever the fund is worth, let's say it's worth 100 million, and 10 million worth of shares redemptions are placed. In other words, a bunch of people, 10 million worth, want to sell. The fund reserves the right to only redeem half of what everybody wanted to sell. Uh, those are called gates, and you have to be aware that if something is going on in the market and you want to get out fast, you may not be able to. Um, Number two, increased costs. So these funds come with a lot higher management fees. They typically start at 1%, but those are the cheapest ones. They kind of go up from there. And the performance numbers, just so everybody knows that I'm that we quote and that we're talking about and in all of these slides, are net of fees. So know that we're talking about after fees, what your take home return is, but um, it may be shocking because we at Anchor Bay um, focus really on saving our clients costs when it comes to our investment choices. So looking at some of the expenses, maybe this it'll be a little bit different because these are quite a bit more expensive. A lot of them even have hurdles, which is where after the fund manager gets to a certain level of performance, you start sharing in the growth. So if they can beat 10%, then the fund manager takes 20% of the next percent. So that's what's called a hurdle. And then also tax reporting. Some of these funds issue K1s instead of the regular 1099 reporting like you would get from publicly traded stocks. So you just have to be aware of all those increased costs and different ways of going about taxes. Limited access. So these funds have investment minimums. They don't want you buying one share; they want you buying hundreds of shares. Or in the past, you used to have to invest with hundreds of thousands of dollars. That's come way down, and I'll talk about how we can get that down even more for being your advisor and sort of these private equity funds and credit funds have given access to advisor clients at a different level. So some of the investment minimums are much lower now, but they all do have them. There's more documentation. It's not as simple as, yep, go ahead and buy it for me, and then we're able to go in there and do it. Most of these have what they call subscription documents. So more paperwork that you need to fill out just to buy any of these investments. And then accreditation. That's another big one. A lot of these funds want or actually restrict only to accredited investors. So you may have heard this term before. An accredited investor can be an institution, a pension, an endowment, a bank, an insurance company, a lot of which none of us are. So, what about for individuals? An accredited investor is considered somebody who has made $200,000 of income over the last 2 out of 3 years, or 300,000 joint if you file a married joint. You have to have that level of income for 2 of the past 3 years and a reasonable expectation to maintain that level for the current year. There's also a net worth restriction where you need to have $1 million of net worth, excluding your primary residence. Not all funds have that accreditation limit, but a lot of them do. Basically, what they're trying to do is they get around a lot of the rules that public markets have to follow. And in order to do that, the government set rules in place that say, okay, you're not allowed to take advantage of the small individual investor by not following our rules that we set up for public markets. So they want to make sure that it's only accredited investors who are accessing these funds that are kind of not the Wild West, but they have less regulations around them.
Mhm.
Lastly, and this goes back to um, sort of the why haven't we done this? Why haven't we been in public or private markets this whole time? The markets evolved. So not too long ago, there were higher minimums, and there were the public markets did a good job addressing kind of all of the areas. And I'll get into more detail on this, but there's some evidence to show that a lot of companies are staying private longer, and a lot of companies are using financing outside of the traditional bank route due to some things we'll talk about. And the last thing is these private market fund companies are finally starting to make it easier for the more regular investor to get access. Where before these used to be previously reserved for institutional investors, meaning it was essentially just endowments, billion-dollar endowments, and pensions. Um, but now that's all changing, which is now sort of the reason we're doing this webinar and feeling like it's time to start stepping up our alternatives game.
Hey, Tanner, can I add some context real quick?
Yeah, of course.
So with a lot of those limitations, there's a finite reason as to why those really exist, especially on the illiquidity part, where there's lockup periods and it takes longer to redeem, your shares in that fund. It's because inherently what a lot of these, especially private credit funds are doing is they're going to companies that need funding, that need to tap into the debt market, that might not have the same access as much bigger companies have. And in exchange for that, the companies that are pooling the capital, the fund companies, they can't just off a whim redeem someone's very large position that they had established with these funds, because it's all tied up into lending into these other companies. And that same phenomenon is also why you're able to get a higher yield on a lot of these funds or larger distributions than if you were to go to the public markets to buy the equivalent, security or public fund, is because the fact that a lot of these companies that are getting the funding from the private credit funds, they have to pay higher interest rates, because they're going the untraditional route, to access that capital. So it's really important to remember why these things are in place, but also because it's the inherent reason as to why there's a lot of illiquidity and some increased costs. There's just a lot more things involved with the activity behind the fund itself. So I
Yeah.
just wanted to add that.
That's a great point, Corey, and you can kind of see it with real estate too. It's not easy to just sell a bunch of real estate in order to meet redemptions, and in fact, a lot of these funds don't want to have to sell just to meet withdrawals. If they don't feel like it's a good time to sell that real estate, they don't want to be forced into it, and that's essentially what they're doing. Whereas these publicly traded REITs have said we understand that we're going the public route, and so we know we have to be liquid and that whole thing. So great point, Corey. Okay, so now we're going to dive into the different types. Private equity specifically, this is a chart that is looking at in the light blue. As we see the light blue kind of over time, these are private companies valued at over a billion. And on the dark blue line, these are public companies that are valued at over a billion. You can see back in as recent as 2010, you just didn't do it. Once you were big enough to go public, it just was a given that you would go public. And now, because of some of the regulations and owners deciding to not want to have to deal with the headaches that come with being a publicly traded company. There's a lot of benefits, but there's also a lot of restrictions, rules, and regulations that you have to follow. And um, For that, those and a lot of other reasons, the number of companies staying private has steadily ticked up over the years to the point now where there's actually more private companies valued at over a billion than there are publicly traded companies. And so what that means is if you're just working in the public markets, you're not getting access to some of these companies, which may be, there's probably a lot of good companies here, and but there's also a lot of good companies in here, and so you're essentially missing out on over half of the market if you're just in public companies. For example, another one I wanted to mention: SpaceX is currently valued at 400 billion, and they're a private company. With I don't really see any news about them going public anytime soon.
Yeah, they don't need
To
to.
give you an example, that's about the size of Home Depot, the publicly traded company Home Depot that we all know and love. Um, I referenced that late stage private equity fund. I wanted to give an example of like what these funds are investing in. So this is a listing of their current holdings or their holdings as of the end of June. Um, a couple to note here: SpaceX, Space Exploration Technologies is the full name, but SpaceX is the more commonly known name. Um, is their second largest holding. Some of you may have seen the recent IPO from Circle. They are a leader in the stablecoin business, which Corey is going to talk about stablecoins in the crypto section a little bit later. Sticking with the crypto theme, Kraken, they are a cryptocurrency exchange, sort of like Coinbase. Um, a couple others that I want to note. Let's see here. Betterment. Some of you may have heard of Epic Games, which they are the makers of Fortnite. Cerebras. They are a AI company that's sort of a competitor of NVIDIA. Masterclass. So these are some of the types of companies that you would get exposure to in this fund, and these are all private currently. Here's another example of a private equity fund, and this is more sort of showing you performance. But I did just want to mention there's different types of private equity, as you might imagine. There's a whole host of different types of private equity. I've been mentioning late stage venture capital. This is more of sort of a middle market core private equity fund. Um, so they're investing in companies not because they think they're going to go public soon, just because they think they're good investments, and they're not hoping they go public. They just think they're the best growth types of investments. So even within private equity, there can be different niches and different ways to make that investment. This one is run by Makita and Primark. Okay, and so for each of these classes, we'll talk about who's the right type of investor. Generally, they're all going to come with investors who want diversification, who are okay tying up that principal, whatever you invest. Think that money is essentially earmarked for long term, and of course, diversification is the other benefit. So we're thinking private equity, long term investors. I'd say at least have in your head a 10 plus year time horizon to really benefit from a private equity investment. But really, there's no 10 is sort of a minimum in my mind. You can actually keep these for the rest of your life, or just think of it as long term. It's not money that you want to put in and and then take out a year later because you're going to buy a house with it, or something like that. Think of this as money that you are not going to touch for a while. Private equity does not typically pay dividends, so it's not a cash flow mode of not a cash flow vehicle. Think accumulators, or in other words, people with long time horizon to retirement. If you can get in early on a private equity fund and let that ride until retirement, that's a great example of who might be well positioned for private equity. It can be good for even retirees and pre-retirees who have a portion of your assets earmarked for legacy, meaning it's essentially just knowing that you're not going to need to access it in a short period of time. And if you're okay with that, then it really can be right for you. And we can hold these in taxable accounts like trusts, individual accounts, or retirement accounts. They can really be good in either case. Moving on to private credit. So this is like the fixed income type. Uh, Private credit really came on as banks started to see more heavy regulation. As soon as banks started to see more heavy regulation, they sort of focused on these top four banks sort of acquired all these regional banks that used to be servicing what they call the middle market. And then that's when private credit companies moved in to provide lending where banks sort of moved away from. You can see here there were Dodd-Frank and Basel III and stuff that came out of the 2008 global financial crisis that made it not really a good incentive for banks to lend in this area, and that's where private credit firms moved in. Here's an example, and mostly I just want to show right here the distribution rate. So this is the type of class that we can get with our advisor or status as an advisor, and your status as a client of our of us being your advisor. And we're talking about a 9.78 distribution. That's the yield. So for those of you on a 4% distribution rate in retirement, we can put you in this fund, give you 4%, and then keep another 5% to invest back into something else. It's really a massive tool private credit is for generating income. Here's an example of the types of sectors that this same fund that we're kind of previewing here invests in. So who is this right for? It's investors seeking income without touching the principal. Remember that the initial investment is sort of locked, but the good news is you can access the dividends along the way. So the way these funds will mechanically work is they actually we open our accounts through Schwab, and we actually can put these investments in Schwab right alongside everything else. So when this fund pays that almost 10% dividend, we can have it sent to cash and we can send it out to you in a distribution. We can use the dividend to then go invest in some other investments. We could even have it reinvested if we wanted to. So really a great income tool. The drawback on private credit is they're fully taxable. So we would say they're best suited for retirement accounts where you're not paying taxes, though they can be appropriate in taxable accounts as well, like trusts. Just know that you have to pay ordinary income tax on those dividends, whether you withdraw them or not. As always, it's good for people looking to diversify, and again, it's a great vehicle for retirees who are looking for income and safety, which again is most people in retirement love income and safety. Private real estate. This is a good chart that shows the difference in volatility of public real estate versus private real estate. Much less volatile. Correlation to equities we sort of already talked about. Much less related to public equities. REITs are even a part of the S&P 500. So whenever the S&P 500 is being sold down, REITs get kind of publicly traded REITs get swept up in that. Private real estate does not so much. Here's an example. I know this might be sort of small. I want to point out an average annualized 5-year return for this real estate fund is 9.6, with 7% of that coming from the distribution. So again, not as high as private credit, but certainly higher than a lot of things you'll find in the stock market, in the bond market. Treasuries are yielding at best for around 4% right now. So really another really good tool for generating income. um, this is an example of the dispersion of this fund, the real estate that they own. This fund that we're looking at here, I'll just point out this industrial warehouse. Um, they have a big partnership with Amazon. And so Amazon is one of their bigger tenants. They own giant plots of land that Amazon works to distribute out of. And when I was sort of um, analyzing these investments, I'm thinking, why would Amazon, a massive company with a lot of cash, not just buy that real estate on their own and then distribute out of it? Why wouldn't they want to own their own building? Well, the answer is they have better things to do with that money. They feel like if we had, let's say, $30 million, we could buy real estate and maybe it gets a 7%, um, return over long periods of time, in the appreciation of it. Or we could take that 30 million and invest it into our core operations and make our processes faster, or hire some new, employees that help make us more efficient and more profitable. And they just view that usage of the money better investing in what they do. They don't want to be in the real estate business because it actually hurts their margins. They're more efficient using that cash for something else. And so that's where we come in to provide um, some cash for the fund to go out and buy those pieces of real estate. And then we use Amazon as the tenant, as an example. So who is private real estate right for? Investors looking for cash flow again, but don't need access to the principal. With all of these, I like to frame yourself as a 10-year lockup, essentially, but uh, really it can be any long-term investment. Again, you can access the dividends along the way, and this is great for individuals who want the real estate exposure without having to own all the physical assets, pay a realtor and collect rent and do all the upkeep and all of the things that you need to do when you are a landlord. Or if you want to get access to the industrial landscape, it's hard to come up with something like $30 million to buy that property. So you can, front maybe $50,000 with a bunch of other investors, and now you have access to um, being to having Amazon as one of your tenants. Um, there's a massive tax benefit with some of these private real estate funds. Dividends can lots of times be tax free due to return of capital. So, because these real estate funds are growing, they're constantly buying new properties. They can take accelerated depreciation, where they essentially depreciate the entire asset in the first year. And then when they go to make their distributions, they categorize it as a return of capital. So it's not that you won't ever have to pay taxes on it, because what it does is it lowers your cost basis so that when you go to sell the fund, you end up with a larger capital gain. But in the meantime, you're getting a lot of times tax-free income. It's not always going to be tax-free because it depends on how the fund is running, but the fund that I've been using as an example, it's been 100% tax-free for at least the last 3 years. So we feel like this is best suited for taxable accounts, people looking for income, safety, diversification, or accumulators looking for long-term growth, diversification. Again, we can use the dividends to supplement your cash flow or to reinvest into something else. um, public markets or private. Now I'm going to kick it over to Corey, who's going to take us on a crypto ride.
Thank you, Tanner. A lot of new, interesting asset classes coming to availability within the individual retail space, and it's going to take a lot of due diligence and research to make sure that a lot of these different investments that we've been talking about are right for a specific client and their specific financial objectives when they want to retire, if they want to partake in a big time purchase. All these things are taken into account before we would even suggest something like a private credit, private real estate fund. And just what another, I guess, another part of this alternatives universe that's probably the newest asset class is what we call digital assets, and more specifically, cryptocurrencies. So I'm going to try to keep this as short as possible, but just so you know, I go down tons of rabbit holes when it comes to learning about this asset class just because it is so fresh and so new. And so the way I'm going to break it down today is that digital assets are kind of the umbrella of, when you have, things like Bitcoin, Ethereum within crypto assets, or you're talking about stable coins, which are becoming a lot more relevant today. There's been legislation that's been passed recently that helps regulate stable coins. And then you have things like NFTs, which in my mind and from what I've seen and experienced within this market, it's more of like a digital art, sort of say. Like if a professional baseball player wanted to have their baseball card in digital form, that would be close to what an NFT is. So that's kind of the overall umbrella for all these different types of new asset classes is digital assets. So going forward, there's just some key terminology of different things that you'll come across when you are looking into the crypto space, and that's, like I said, the digital assets is the umbrella term for everything that we're talking about, and a lot of those, if not all, digital assets are traded on the blockchain, which plain and short is a technology solution that enables these digital assets to exist. And diving in a little bit deeper, it's a way to securely record information, on a very surface level way of explaining it, on a peer-to-peer network. So it's a shared public database, which is duplicated across computer systems in which, new entries can be added, but existing entries can't be altered. And that is pretty much a way to, think about the blockchain and where all these digital assets exist. Now, probably something that you've all heard by now and is the most popular type of cryptocurrency is called Bitcoin. And so, as it says on the slide, it's the world's leading and most adopted cryptocurrency. It's the first one to get worldwide adoption. You see a lot of institutions starting to gain interest. Companies like BlackRock and Fidelity are creating ETFs to track the spot price of Bitcoin. It's the first established cryptocurrency that's gained popularity, and there's some mechanics behind it that I can dive deeper into if you're more curious about it. But it has kind of a dual existence in terms of either an investment or something that can be used as a utility. And then beyond Bitcoin, you have these things called stable coins, which in effect are tracked to the value of the dollar and basically allow companies or institutions that are international to be able to partake in Forex and other related things and avoid a lot of the volatility when it comes to foreign exchange and a lot of the higher fees. So going forward here, I wanted to stress that with this new asset class of digital assets and cryptocurrencies, one thing to take home is that you don't use traditional valuation methods to place a value or a price target or something like this on cryptocurrencies. There's a slightly different, I guess, umbrella of ways to look at crypto and what its value, could be. Kind of, make some estimates on that specific type of valuation. The three things that are definitely becoming the norm for trying to assign a value to a cryptocurrency are what you have, or what are called network effects, utility, and of course potential for future returns. Now, network effects in simple terms is a good relatable example for this is that a social media platform is much more powerful and much more valuable if it has 100 million users rather than say a million users. It's more valuable for the platform itself, but it's also more valuable for advertisers to come on board and to sell advertisements. It's very similar with a lot of these cryptocurrencies, is that if the audience or the users expand in terms of quantity for these cryptocurrencies, it's a way for investors or analysts to measure what maybe a value can come from a certain type of crypto like Bitcoin or Ethereum, things like that. And then the other main way that a lot of analysts are looking into assigning a type of value towards these new assets is utility. So a lot of these cryptocurrencies that you'll see, like I said, kind of have a dual way of existing. So that network effect plays a lot into the asset price, but also the utility behind a lot of these cryptos. And I'll keep using Bitcoin because it's the most popular example, is that not only has Bitcoin been seen as more of like a digital gold where there's a limited supply, there's decent monetary mechanics behind it that will naturally inflate the price over time, is the theory, but you can also use it as a payment method. So they have what's called the Lightning Network, and you can use it to send payments from one part of the world to another and have it still be synonymous using Bitcoin rather than different kinds of currencies. So it has some utility behind it as a medium of exchange. And from looking into it and looking at the mechanics behind how Bitcoin operates, it looks like it's going from being more of a speculative asset with a lot of volatility, that risk reward trade off that Tanner was talking about, to eventually becoming more of a store of value type of asset, like I said, like a digital gold, with all those different mechanics that I talked about, like a limited supply and deflationary effects of how it operates. So, um, like I said, you can't. A lot of these cryptocurrencies don't project free cash flows. They don't, show earnings and margins and whatnot. So it's a lot harder to go the traditional route, like a discounted cash flow model, or to do a relative valuation, because there's different mechanics behind it. So um, going on from there, I mean, if you just pay attention to a day's worth of the prices of a lot of these cryptos, they move around a lot, and it's due to a variety of different effects. But some of the few things that I'll touch upon here quickly are that adoption from not just retail, but now companies, investment firms, and governments, where a corporation will maybe build a treasury account with Bitcoin or Ethereum held in there instead of cash, or in addition to cash. When there's new players entering the space, there's bound to be a lot more volatility involved, because there's a lot more trading of hands to buying or selling the asset. And same thing goes with economic performance. As of lately, the last few years of its existence, there's been a pretty high correlation, but maybe just a more levered version or a higher beta to crypto over, say stocks or real estate. So there's still a pretty high correlation when it comes to how stocks and other assets are doing. It's just a much more volatile version. But like I said, over time, if it becomes more adopted, you'll most likely see that volatility come down. And then lastly, there are things like regulatory actions, like bills that are signed that help actually build guardrails and regulations for it to be a safer asset class to participate in. That'll also bring upon more volatility. And then there's also network updates for a lot of these cryptos, where there are teams of developers that come together that help do routine updates to make it a more efficient, or to be more fair in terms of how the whole system operates behind the cryptocurrencies. So a lot of these things add in additional volatility, and is also one of the biggest things is that these cryptocurrencies trade 24 hours versus what stocks trade, what is it, 9, 10 hours of the day. It's a big difference in terms of when it's available to be bought or sold. So there's just a lot more volatility involved. And so it's really important to understand that even though there's a high potential of a reward or a return, that also comes with extremely high risks. And really quickly, there's things like I just mentioned, a lot of volatility, a lot of regulations that's coming on board that might change how the environment actually operates. And then a big one that a lot of clients that we've talked to at Anchor Bay have come across things like scams, like people promising to deliver, say, like, you got an email from Elon Musk saying that he wants to send you 500 Bitcoin. Those are all different kinds of scams that go on to try to bait people into entering the space, when it's really important that if you wanted to take part and you have the appetite for risk, that you go through professional means like an exchange, like a Coinbase or a Kraken, or to do cold storage where you don't even go through an exchange. You buy it with a cold wallet and then you just have like a USB stick. So it's really important to understand that there are very high inherent risks and things you have to pay attention to partake in this asset class. But that's just what comes with the high risk, high reward trade off. And so to finish it off, it's only right for your portfolio if you're willing to stomach the volatility, if you have a very high risk tolerance with a very long time horizon, because this is a brand new asset class. It's very speculative in nature, so you can see something drop by 60% in a month, and you have to be okay with that because, again, brand new asset class, there's a lot of speculation. So I know that's not as long as I wanted to go into, but because we have limited time here, we're going to move on. But if you have other questions about it, please feel free to email me or send something in the chat. But I'll let Tanner go on with the last part of our presentation here.
Yeah, thanks, Corey. Yep, we're getting up against it here, so I'm going to try to go quickly. I did want to mention on cryptos, right now it's not something that we can provide as to you as advisors. So if you are interested in crypto, we can have a discussion about it. But again, it wouldn't be something we'd be able to do on your behalf. But again, we can have that discussion if you want. I also want to mention I should have mentioned it off the top, but we have. If you have any questions, feel free to send them in the chat, and we'll address them as soon as we're done here. We've got about 6 more slides to get through, and then we'll start taking questions. And apologies if we go slightly over. We're going to talk about commodities right now. So commodities there's different types. We're talking about things like precious metals, which includes gold and silver and platinum, things like that. Energy like oil and natural gas, industrial metals like aluminum, steel, copper, cobalt, things like that. Agriculture like grains, soybeans, and then also livestock like cattle and pigs and things like that. So commodities really spans a broad category. So when we're talking about the broad category, I just wanted to show this chart that sort of shows all different. These are actually just publicly traded asset classes, but we've done a bunch of research on this because we do get questions about commodities, and for the time being, we just don't feel like the long-term performance for the risk you're taking is there. For example, this shows each year, and commodities is in the dark green. You'll notice commodities are down in the bottom for quite a bit of time. Now, there are times where commodities really shine, and we'll talk about what types of markets those are, what kind of backdrop is good for commodities. But if you take the average over here on the left since 2010, the average annualized return of commodities is actually the worst performing class at -1%, yet it has sort of an average volatility. In fact, I would even categorize it as a high volatility because the volatility is slightly higher than even US stocks. So for less volatility, you can get the best return in large caps over the last 14 years. Gold is probably the most prominent of all the commodities, and the one that we get the most questions about. I would, in my opinion, it's useful in the short term, not necessarily the long term, and only if you're certain about one of two things. If you think we're going to have high inflation, or if you think we're going to have a market correction. It's best used as a hedge against the markets and economy. The problem I have with that is most of the time the markets and the economy are up and doing well. If you look back at, over time, we all know the economy averages about a 2 to 3% growth. Markets average about 10%, and most years they're up. So if you're using this, if this is a type of investment that sort of does the opposite of what markets do, that means it's going to be down most of the time. So you must have good timing in and out. That's a big thing. I think I get a lot of questions about should we invest in this, and I've got this speculative investment. I always tell people it's harder to find the selling point than it is to actually go in there and buy. And that's sort of what you have with gold, where you have to pick a good selling point. Um, and then again, can maintain buying power in high inflationary environment when we have rampant inflation like we sort of had the last 5 years. Gold's done really well. Um, the problem is, again, everything else does well too, especially stocks. Stocks have done really well recently, and again with similar to less volatility. So gold, who is it right for? I would say investments or investors who are pessimistic about the short term economy or expect near term inflation. Investors who don't need cash flow, because obviously gold doesn't spit out dividends or any kind of cash flow. In my opinion, it's not great for long term investing just because there's gold does appreciate over time. It's just that other asset classes appreciate more for even less volatility. So, in our opinion, the risk reward trade off is just not there. So, the best use of it is as a diversifier. And again, short term, if you expect something to go wrong in the economy or high inflation. So, this is the slide we sort of been working up to the whole time. These are sort of our best examples of performance on the left and volatility on the right. So again, um, you want to be high on the left and you want to be low on the right. So you can see public stock market is here, but private stocks and private equity up here. And yet on the volatility scale, public stock market is actually the highest, and private markets are somewhere in here between commodities and public fixed income. So a really good risk reward trade off for private equity. You see that again here with private infrastructure, where we're higher on the profile of return, but we're lower on the risk profile. Commodities again not scoring very well, and gold averaging a 4 to 6% annualized return, but almost the same volatility as the public stock market. And these numbers go back 50 years as what we're using. Basically, since it's actually been sort of a clean 50 years, the US went off the gold standard in 71 and then spent a few years sort of getting out of the gold standard until 75 is kind of widely considered about when we were fully off of it. So a good measuring tool. And again, stock market up 10 to 12 over that period of time, yet around the same volatility profile. So just a slide I wanted to throw on here to show you each of the private investments has a really good risk return profile. It's just you have to know that you're giving up liquidity and you have to meet certain parameters and all of the things. It's more legwork for you as a client because you have to sign a bunch of documents and things like that. So um, if you're on board and you're okay with that, then it may be right for you. So how do you invest in these things that we've been talking about and sort of preaching to you as clients, and maybe prospective clients or just investors in general? Reach out to your advisor. You can, if you're an Anchor Bay client, you can reach out to whoever your advisor is, you can call into our office and speak to just about anyone to set up a discussion. You can call me and or Corey, and either of us will be happy to set up a call to see if investments or if alternatives are right for you, and if and which types. And we can talk about a lot more detail, sort of one on one. We also plan to discuss these opportunities at the next update meeting. Whoever your advisor is, hopefully, will discuss it with you. Although, as many of you may know, we do some pretty heavy financial planning and tax work for you. So sometimes these things can get missed. So if it is something that's of interest of you, feel free to bring it up. And as advisors, we do have access to certain share classes and certain investment options that you wouldn't have if you just tried to go straight to the fund yourself. Um, I will mention, because it sounds like we're sort of saying we are advocating for private investments. We don't get paid or compensated any differently whether your investments are in public markets or private markets. So hopefully that um, is reason to really consider alternatives if you're in one of these categories that we've discussed. Because again, there's no benefit, I guess, to us at Anchor Bay. We just feel like it's a benefit for you as the client and as the investor, and that's the reason why we're putting on this webinar and discussing the different elements of it. So thanks everyone for attending. I apologize again, we did go a little bit over. If we have any questions in the chat, we'll start looking at them right now. But thanks again everyone for joining if you have to jump.